Hi, my name is Eduardo Romeo. I'm a 16-year-old aspiring to work in finance in the future, and I have many passions, four of which are economics, finance, mathematics, and coding. And I tried to combine all four of them into this project. As I said previously, I want to work in finance, and I'm undecided between M&A because I like the human side, and quantitative research and trading because I am also discreetly good with mathematics. So I coded this trading strategy and then backtested it, and it's a PEAD strategy. That meaning that it focuses on post-earnings announcement drift, which is an anomaly in quantitative finance that has been able to be exploited for many, many years, although mine is slightly revisited. Here I have projected the Python code to run the backtesting, and we can see it's a simple point system based on this data. This data is logarithmic change of certain fundamental analysis metrics that can be found in the income statement or balance sheet or cash flow statement. And then it assigns points at various stocks, and if they exceed a certain percentage threshold of good points over total possible points, then it simulates a buy, and the rest of the code is handling this trading simulation, so computing the final value of the simulated portfolio after the quarter passes, because this is not yearly, it's quarterly, and then after it plots everything. So there was a big pivot with the developing of this strategy. Let me go back to the presentation to talk about it. So at the start, I had these logarithmic change, except for share dilution that was in percentage, but I wanted to go and calculate exactly, with minimum error, the logarithmic change in price. I chose logarithmic because it's symmetric across gain and loss, and I wanted to go and calculate precisely the change, and that was going to be very hard, especially with the small data set Yahoo Finance gives me, and the lack of precision Yahoo Finance often has, as it is a free data source. So the pivot was directional accuracy, because my initial model did have 56% directional accuracy, I think it was, but it could have been refined. And how did I refine it? Well, I assigned a point system. I've talked about it being a point system, but what precisely is taken into consideration? Well, we're taking into consideration sales, cash flow, net income, weighted average cost of capital, debt, and no new shares. In fact, the model heavily penalizes share dilution. Now let's look at exactly what happens in this code to make it function and assign the points. So if positive metrics increase, like operating cash flow, revenue, net profit, net income, increase, then a point is assigned. Then if a weighted average cost of capital decreases, a positive point is assigned, or else a negative point is assigned. And this Boolean value, whack use, is set to true if a weighted average cost of capital decreases. And then debt becomes a sensible thing to take on in order to invest in the business. So acquiring new debt is heavily rewarded, while acquiring debt while weighted average cost of capital increases is penalized. Another thing that is heavily penalized is share dilution percentage. So if shares are diluted, 2 negative points are assigned, otherwise 2 positive points are assigned. And then we have a simple expression that gives the total points we have, so positive plus negative, and it divides the positive over everything. And if that result is above 0.6, which was our initial threshold, it simulates the buy. The passing grade for this strategy is 0.6, so 60%, and it was tested against other two scores, such as 0.4 and 0.8, and 0.6 was the best fitting. That is because 0.4 was not selective enough and was selecting a lot of losers, and basically all of the 180 stocks could pass the test, or at least more than 100, while 0.8 only selected about 11 stocks. And that drastically increased the portfolio standard deviation, so a lot of volatility, more risk, and it made sure the returns that were higher than the 0.6 version were carried by companies, often in the same sector, so it was extremely sector dependent and much more risky than the 0.6, which had better metrics such as better standard deviation and still above average returns. In the first version of the code, I made an important mistake, treating surging WACC as a good thing, while it was actually cost of capital. So its surging was bad for the business. And I adjusted also the debt take on feature so that if borrowing money comes with a lesser cost of capital, it is actually smart to borrow money because then the business can reinvest it in itself at a cheaper price. So if a company takes on debt but its overall cost of capital drops, 2 points, which are a bonus point more, are assigned to the positive points because it's considered a smart leverage. If not, 2 points are detracted because increasing debt and increasing weighted average cost of capital is much worse than lowering weighted average cost of capital and increasing debt at the same time. And then lowering debt is normally just 1 bonus point more. If debt doesn't surge, it's usually always good. But you can see how then real-life adaptability of this model crumbles because it doesn't take into consideration all the reasons why debt may surge, but the overall thinking behind it is if debt is not used as a financial life jacket, but it's used as a way to not give up equity while still raising capital and keeping WACC low, then it is to be rewarded. So now let's look at the results of this backtest of our quarter. We can see we started with $100,000 and ended with a total profit and loss of plus $6,733 with a 6.74% gain, or 674 basis points, and a pretty good win rate, so directional accuracy of 61.11%. I'll plot the more detailed graph now as well. We can see our equity line is quite choppy, and at the start we also have losing trades, so at the very start we are in a deficit, but we are still gaining, so we are still in an uptrend, and annualize these returns, if we take this one analyzed quarter as our mean. I know it's not nearly as enough data to determine annual mean gain, but it would be 30%, exactly 29.8. And we can see it being choppy, signaling the strategy to be volatile. That's why the Sharpe ratio was actually below 1, and it would have, although returns were higher in this quarter, volatility makes it too risky to compare to a normal index fund. So this is not financial advice in any way. We can see also plotted in the next slide our top performers and our equity curve. And what are the problems to solve in this strategy? Well, first of all, it's only backtested in one quarter, in one market condition, so bull, it's 2026, so we are in a bull market. And there are no emergency buttons, so stop loss and take profits are neglected, and all stocks are treated equal. So there is not capital allocation that depends on volatility, past performance. It's all treated equal. So 100,000 divided by number of selected stocks is the capital allocation for every stock. So in our next video, I will bring the version 3.0, where capital allocation will be sorted. There will be stop loss and take profit, and it will be backtested on different market conditions. The reason why I did not backtest it in the past is because Yahoo Finance, unfortunately, loses a lot of accuracy and does not have a lot of precise data often for earlier years, and that's a bit its flaw, but it is still a great service because it's free and it's allowed me to pull all this data quickly. Going back to the code, I believe the flaws are in technicalities, like the weights we assign to different points. So plus X change is treated the same as a plus Y change. It's not weighted towards different changes, and also equity dilution, that if a company dilutes another 10%, it's treated the same as if it diluted 20%. And then it's not properly optimized because I believe, yes, we set the threshold to 0.6 and we tested other two, but why not 0.61? Why not 0.59? And keeping only integers in the weights loses a lot of optimization power. And I have no clue if this strategy is overfitted. I could guess not, because it's rooted in economic intuition, but truly without backtesting it on other data, there is not a way to know if the strategy is overfitted. We can guess that it's not overfitted because it makes sense economically. Additionally, this backtester does not account for slippage, although a couple dollars of slippage can be negligible on a $100,000 account. That is all for today. Thank you for watching. Hit the like button and subscribe, and if you would like to offer me an internship, I would be really happy accepting. I'll be back with the other videos and the 3.0 version of the strategy, hopefully to improve it and backtest it over different time periods. If you are experienced in this field and want to give me feedback, please don't hesitate to comment under this video, as all comments are appreciated, and I'm really just here to learn more about finance, quantitative finance, and everything that this field has to offer. Thanks for watching.